Every financial guru, every school textbook, every motivational post about building wealth tells you the same thing. Save money, invest it, let compound interest do the work, and in 40 years you'll be rich. What they never tell you is that the people who are actually rich right now, the ones with the cars, the properties, the passive income, the freedom, they are not waiting 40 years. And most of them are not relying on compound interest the way you were taught. In fact, some of the wealthiest people in the world have publicly said that compound interest, the thing you've been told is your greatest financial weapon, is actually the slowest path to wealth for someone starting with nothing. Stay with me, because by the end of this video you're going to see the entire game differently. Let's start with what you were taught. Compound interest is when your money earns returns, and then those returns earn returns, and it keeps snowballing over time. The classic example goes like this. You invest $10,000 at a 7% annual return. After 10 years you have around $19,000. After 30 years you have around $76,000. After 40 years you have nearly $150,000. That sounds incredible until you realize you waited 40 years and you only turned $10,000 into $150,000. If you started with just $10,000. Here's the problem nobody talks about. Compound interest is extraordinary when you already have significant capital. It is painfully slow when you don't. A billionaire putting $10 million into a 7% annual return account makes $700,000 in year one without lifting a finger. You putting in $200 a month make almost nothing in year one. The math doesn't lie. Compounding rewards those who already have. It barely moves the needle for those who are just starting. And this is where the story gets interesting, because the wealthy didn't build their wealth by waiting for compounding to kick in. They built their wealth first, and then they used compounding to protect and grow what they already had. That is the sequence nobody teaches you. Build first. Compound second. You've been taught to do it backwards. So how did they actually build it? This is the part of the financial conversation that almost never makes it into mainstream content, because it's less comfortable and more confrontational than a chart showing a smooth upward curve. The wealthy built their initial wealth through income acceleration, not patience. They found ways to increase what they earned dramatically, not incrementally. They didn't save their way to their first 100,000. They earned their way there, and they did it fast. Think about the difference between someone who earns $40,000 a year and saves 10%, and someone who finds a way to earn $120,000 a year and saves 30%. The first person saves $4,000 a year. The second person saves $36,000 a year. In the same amount of time, the second person isn't just ahead, they are in a completely different financial reality. And the gap between them has nothing to do with compound interest. It has everything to do with how much money is coming in. Now here is where this gets personal. If you are currently living paycheck to paycheck, or if you're saving a small percentage of a modest income and hoping compounding will one day rescue you, the math is working against you in a way most finance content will never say out loud. The average person in the United States takes approximately 25 to 30 years of diligent saving and investing to accumulate enough to feel financially free. 25 to 30 years. That is your 40s, your 50s, your most energetic decades, spent waiting. And that's if everything goes right, if markets don't crash, if you don't lose your job, if inflation doesn't eat your returns, if life doesn't happen. The wealthy understood something else. Time in the market matters, yes. But income and asset ownership matter more at the start. Before you can compound, you need something worth compounding. And a few $100s a month is not that thing. Not at the speed most people need. Here's the shift that changes everything. The wealthy don't think in terms of saving a percentage of income. They think in terms of acquiring assets that generate income. There is a foundational difference between those two mindsets. Saving is passive and slow. Acquiring income-generating assets is active and scalable. Real estate that pays you rent. A business that runs without your constant presence. Content, products, or systems that earn money repeatedly from a single effort. Skills so valuable that the market pays a premium for them. These are the vehicles the wealthy actually use to build the base that compounding then multiplies. And this brings us back to where compounding actually belongs in the wealth equation. It is not the engine. It is the amplifier. Once you have built a meaningful base, whether through a business exit, accumulated real estate equity, a high-income career strategically managed, or any combination of income acceleration strategies, compound growth becomes one of the most powerful forces in the world. A person who builds their first $500,000 through aggressive income generation and asset acquisition, and then invests that into diversified assets at a 7% return, is making $35,000 a year passively, without touching the principal. That is where compounding becomes life-changing. But they had to build the $500,000 first. The uncomfortable truth is that most people are playing the right game with the wrong strategy for where they are in life. If you are young, if your income is modest, if you are just starting out, the highest return on investment you can make right now is not in the stock market. It is in yourself. In skills that command higher pay. In knowledge that opens higher income opportunities. In systems that separate your time from your earning. Every dollar you invest in becoming more valuable to the market compounds faster in your 20s and 30s than any index fund ever will. The wealthy don't tell you this directly, because frankly the financial services industry makes money when you invest early and often regardless of how long it takes. They benefit from your patience. They benefit from the 40-year timeline. They need you to believe that slow and steady is the only path. It isn't. It is one path. And it is the slowest one available to you. Here's what the financial world will not say to your face. Compound interest is miraculous once you are wealthy. Before that, your most powerful compounding asset is your own earning potential, applied aggressively and intelligently. The people you admire financially did not outsave you. They out-earned you, out-acquired you, and then let compounding do what it does best, which is protect and multiply what already exists. So the next time someone tells you to just trust the process, be patient, let compound interest work its magic, ask yourself one honest question. At the pace I am currently on, what does my financial life actually look like in 10 years? If the answer doesn't excite you, the strategy needs to change. Not the timeline. Not your patience. The strategy. Compounding is real. Compounding is powerful. But it was never designed to replace income. It was designed to reward capital. And until you build real capital, the most important investment you will ever make is the one you make in your own financial education, your skills, your income, and your ability to acquire assets that pay you back. That is the actual foundation. Everything else grows on top of it.